In 2023, more than $7 trillion was invested in U.S. index mutual funds. At the same time, ETFs crossed $8 trillion in assets. Two different investment vehicles, both tracking the same markets, both recommended by financial experts. And yet millions of investors still ask the same question. Are they actually different, or are we arguing over two versions of the same thing? Because here's the strange part. Two people can invest in the exact same S&P 500 companies, own the exact same stocks, earn almost identical long-term returns, and still end up with different results. Why? That answer reveals one of the most misunderstood details in modern investing. And if you're building wealth for the next 20-30 years, this small difference could quietly shape how your money grows. If you search online for beginner investing advice, you'll hear the same phrase again and again. Just buy index funds. But then someone else says, no, ETFs are better. And suddenly, the conversation becomes confusing. Is one cheaper? Is one safer? Is one better for taxes? Or is the difference mostly marketing? For new investors, especially those in their 20s and 30s, this confusion creates hesitation. And hesitation costs time. Because the biggest driver of long-term wealth isn't picking the perfect investment. It's starting early and staying consistent. But here's what most people don't realize. Index funds and ETFs are not actually competitors. In many cases, they're simply different wrappers around the same strategy. And once you understand that, everything becomes much clearer. Why most investors get it wrong. The reason this topic confuses people is because of language. People often say, index fund versus ETF. But that's technically not the right comparison. Because index fund describes the strategy, while ETF describes the structure. An index fund simply means a fund that tracks a market index. For example, the S&P 500, the total U.S. stock market, the Nasdaq 100. Instead of trying to beat the market, the fund simply copies it. This idea became famous when legendary investor John Bogle created the first retail index fund in 1976. Today, index investing is one of the most widely recommended strategies in finance. In fact, according to Morningstar, passive funds now hold more assets than actively managed funds in the U.S. But here, where things get interesting. That same index strategy can exist in two different formats. Index mutual funds, ETFs, exchange-traded funds. And understanding the difference between these formats changes how you invest. Let's simplify this. Think of investing like buying groceries. Two stores might sell the exact same product, but one is a supermarket. The other is a warehouse store. The product is identical, but how you buy it is different. That's essentially the difference between index mutual funds and ETFs. Index mutual funds. Index mutual funds are bought directly from the fund company. Examples include funds from Vanguard, Fidelity, or Schwab. You invest a dollar amount, say $500, and the transaction is executed once per day after the market closes. The price is called the NAV, net asset value. So if the market moves during the day, you don't see those changes immediately. You simply get the closing price. For long-term investors, this system works perfectly fine. But ETFs operate differently. ETFs, exchange-traded funds. ETFs trade on the stock market, just like individual stocks. That means you can buy them anytime during market hours. Their price moves throughout the day. For example, if the market rises at 10:30 a.m., the ETF price rises too. This makes ETFs feel more familiar to people who already trade stocks. But here the key insight. Many ETFs and index funds track the exact same index. For example, the S&P 500 can be tracked by both a mutual fund and an ETF. Same companies, same allocation, nearly identical returns, but their structure and trading behavior differ slightly. And this is where the real differences start to matter. Let's imagine two investors. Both are 30 years old. Both invest $500 per month. Both choose an S&P 500 strategy. Investor A chooses an index mutual fund. Investor B chooses an ETF tracking the same index. Historically, the S&P 500 has returned around 10% annually before inflation. After 30 years, both investors could have roughly $1 million. So from a pure performance perspective, the difference between index funds and ETFs is usually very small. But there are still a few practical differences that investors should understand. And this is where many beginners accidentally make mistakes. Common mistakes. Mistake 1. Thinking ETFs always perform better. They don't. If both funds track the same index and have similar fees, performance will be nearly identical. Mistake 2. Ignoring expense ratios. Expense ratios matter more than structure. For example, an index fund charging 0.03% annually is cheaper than another charging 0.25%, regardless of whether it's an ETF or mutual fund. Over decades, this difference can quietly cost tens of thousands of dollars. Mistake 3. Overtrading ETFs. Because ETFs trade like stocks, investors sometimes treat them like trading tools. Buying, selling, timing the market. But here's the uncomfortable truth. The more often investors trade, the worse their long-term returns usually become. Patience beats activity. Almost every time. Clear step-by-step strategy. So if you're starting today, here's a simple framework many long-term investors follow. Step 1. Choose the market. Start with broad diversification. Examples include total U.S. stock market, S&P 500, total world market. These funds hold hundreds or thousands of companies. Step 2. Compare fees. Look for expense ratios under 0.1% if possible. Many popular funds today charge 0.03% or less. That's just $3 per year for every $10,000 invested. Step 3. Decide the structure. Choose between index mutual fund, ETF. If you prefer automatic investing, mutual funds can be easier. If you prefer flexibility and intraday trading, ETFs may feel more comfortable. But remember, this decision is far less important than simply investing consistently. And this brings us to something deeper. Most investing mistakes are not technical. They're psychological. People worry about market crashes, recessions, inflation, taxes. But history shows something powerful. Since 1926, the U.S. stock market has experienced the Great Depression, world wars, oil crises, financial crashes, global pandemics, and yet the market has continued to grow over the long term. This doesn't mean markets are safe in the short term. They absolutely are. But long-term investors who stay disciplined tend to benefit from economic growth and corporate innovation. And index funds, whether an ETF or mutual fund, allow investors to capture that growth without trying to outsmart the market. By the way, I'm curious about something. How old are you right now? And when did you start investing? Drop your age in the comments. It's always fascinating to see how early people begin their investing journey. Also, if you already invest in ETFs, which one do you currently hold the most of? S&P 500, total market, something else? Let me know in the comments. It helps others discover ideas too. Here's a perspective that sometimes surprises people. For most long-term investors, the ETF versus index fund debate is slightly overrated. The bigger factors are savings rate, time in the market, fees, emotional discipline. Someone who invests $1,000 every month for 25 years will likely outperform someone who perfectly optimizes ETFs but invests inconsistently. Consistency beats optimization every time, but not everyone agrees with that. So I'm curious, do you think the ETF versus mutual fund choice actually matters long term? Let's discuss. Let's simplify everything we covered. An index fund is a strategy that tracks a market index. An ETF is a structure that trades on the stock exchange. Both can track the same indexes. Both can deliver similar returns. Both are widely used by long-term investors. The biggest differences are trading style, tax efficiency in some cases, ease of automatic investing. But in the long run, the real wealth builders are simple habits. Invest regularly. Keep fees low. Stay diversified. Ignore short-term noise. Because the truth is, wealth rarely comes from clever tricks. It usually comes from quiet consistency. The investor who steadily buys broad market funds for decades often outperforms the one constantly searching for the perfect strategy. And that's the quiet power of index investing. It replaces prediction with participation. If you learned something useful from this video, consider hitting the like button. It helps more investors discover this type of content. And if you're building long-term wealth through ETFs, index funds, and smart retirement strategies, subscribe. This channel is all about simple, data-driven investing without hype. And if you want to go deeper, the next video breaks down how to build a complete 3-fund portfolio using ETFs, one of the most popular strategies among long-term investors. Because at the end of the day, successful investing isn't about finding the perfect moment. It's about owning great businesses and giving them time to work for you.